Hello, dear viewers, today let's try to understand how good or bad business are football clubs. Football might be the world's most popular sport, but behind the passion, the drama, and the billion-dollar stadiums lies a surprising truth: most football clubs is not good, not to say, terrible businesses. Despite massive fan bases and global attention, many teams struggle to make profit, survive financially, or even stay out of debt. In today's video, we're breaking down why football, unlike many other sports industries, often fails as a sustainable business. From overspending on players to unpredictable revenues and the intense pressure to win at all costs, let's uncover what's really happening behind the scenes in the world's favorite game. Let's start with some bad news, because financial problems or even clubs going bust tend to make headlines more often. But not everything is bleak. Some football clubs are so well managed that they even outperform the S&P 500 index fund. Which clubs? You'll find out in this video. That said, it is not all doom and gloom in the top leagues. The Premier League and other elite divisions do generate huge revenues, and some clubs are doing okay. But the deeper financial problems of football are far more visible outside the very top. For instance, in France, several clubs are struggling. Olympique Lyonnais recently came under scrutiny for more than €500 million in debt, facing a provisional relegation, and eventually was saved partly by rivals Paris Saint-Germain, who paid remainder of Bradley Barcola transfer earlier than it was agreed by transfer contract. This was done perhaps to avoid bad image of league and leave such iconic club in league, because league where no famous brands exist could less attract fans and so will be less profitable. Meanwhile, Girondins de Bordeaux, six-time French Ligue 1 champions, a club where Zinedine Zidane made his name as a youngster, went bankrupt in 2024. Then club were administratively relegated and now competes in the Championnat National Second Division, the fourth tier of football in France. This was due to financial mismanagement during ownership of G.Lopez, who appears to own Portuguese club Boavista, and guess that, this club also got into financial troubles and were administratively relegated from top league. The club became riddled with debt, owing €7 million to the construction company handling their stadium development. Boavista was deprived of electricity at their Bessa stadium due to unpaid bills. This incident lasted almost a week and symbolized the depth of the club's financial crisis. These clubs, as well as Royal Excel Mouscron in Belgium, and Lille Olympique Sporting Club, another French club where Lopez was owner, were unsuccessful not because of bad football alone, but because they combined high debt, poor planning, short-termism, and weak revenue models. In other words, they were built on fragile foundations, flashy ambition without sustainable business strategy. Bankruptcies in football, like in any other business, are not uncommon, but they attract extra attention because of the emotional and cultural significance of clubs. Some of the most famous clubs to have gone through bankruptcy and later returned include Napoli, one of Italy's most iconic teams, which fell into decline both on and off the pitch after Diego Maradona's departure, Rangers in Scotland, AEK Athens in Greece, and several others. While top leagues like the Premier League generate huge revenues and can survive financial shocks, the situation in lower leagues is far more dire. Once you step outside the elite divisions, money dries up quickly. TV deals are tiny, sponsorships are limited, and matchday income is minimal. Yet costs like stadium upkeep, wages, and travel remain high, creating a massive imbalance. This makes lower league clubs heavily dependent on their owners, and when those owners lose money or interest, clubs collapse almost overnight. Relegation can be a death sentence, and many teams simply cannot absorb even small financial losses. A striking example comes from Latvia's Versliga. Historically, Skando FC dominated the league, winning 15 titles, from which first 14 in the row. Shared European record, by the way, was declared bankrupt in 2016, later followed by disappearing from professional level of other championship winning clubs such as FK Ventspils, Spartak Jurmala, leaving that only 8 of last 34 championship-winning teams continue to play professionally in higher league. Rich owners also does not spare clubs. Here are two powerful examples showing how rich owners don't always protect clubs. Sometimes, they actually make things worse, as in case of Malaga CF and Ansji Mahajkala. Malaga CF was bought in 2010 by Qatari Sheikh Abdullah Al Thani, who injected a lot of money and brought big names, but things turned sour. Over the years, prosecutors say the Al Thani family emptied out the club. They allegedly took inflated salaries, secured loans for themselves, rented properties via the club, and even bought shares using club funds. A Spanish court has now ordered Al Thani and his sons to stand trial for misappropriation and disloyal administration. Meanwhile, the club has struggled on the sporting side, after peaking in European competition including Champions League run to quarter-finals in 2013. After that, in few years' time, Malaga got relegated from La Liga and now try to keep in Segunda Division, where they returned after 1 year in the third tier. Suleiman Kerimov, a Russian billionaire, bought Ansji Mahajkala in 2011 and made it a glamour project. He spent huge sums. Signings included Samuel Eto'o, Roberto Carlos, and others. But just in few years, things changed drastically. In 2013, Kerimov slashed the club's budget by 2/3, triggering a fire sale of its top players. With funding gone, the club couldn't sustain its star-studded model. Within a short time, Ansji went from being a high-profile club to struggling for relevance. Eventually, Kerimov sold the club in 2016 and Ansji faded from the top tier and later lost its professional status, which they try to get back in 2025. On-field success does not guarantee financial stability in long term. Deportivo La Coruña's history the best illustrates that. The club reached its peak in the late 1990s and early 2000s, winning La Liga in 2000 and regularly competing in the Champions League, even reaching the quarter-finals and semi-finals in several seasons. These achievements brought prestige, prize money, and short-term revenue boosts. However, the club simultaneously spent heavily on high-profile players such as Roy Mackay, Mauro Silva, and Bebeto, as well as on wages, stadium upgrades, and infrastructure, often relying on loans to fund these ambitions. When results declined and Deportivo was relegated from La Liga in 2010, the expected revenue from TV rights, ticket sales, and European competitions vanished, leaving the club with a mountain of debt. Even though the trophies brought fame, they did not prevent the club from entering a bankruptcy procedure in 2013, which lasted more than a decade. Tradition-rich clubs in other countries are also not spared, as Brescia Calcio, a club with more than a century of history and by the way club where such footballing icons as Roberto Baggio and Pep Guardiola have played, declared bankruptcy in 2025. The situation isn't limited to Europe. China's Superleague rocked the football world with a number of expensive signings in 2016 and 2017, including international stars like Oscar, Hulk, and Axel Witsel, as clubs sought to rapidly raise the league's profile. However, the boom proved unsustainable. Many clubs relied heavily on funding from wealthy owners or parent companies, and when those backers faced financial difficulties, the clubs collapsed. For example, Jiangsu Suning, champions in 2020, folded due to the Suning Group's financial troubles in 2021, just months after their winning title. Later, same Suning Group, who owned Italian club Inter Milan as well, failed to repay a €395 million loan, and in May 2024, Oak Tree Capital Management, American company who issued the loan, officially became the new owner of Inter Milan. Returning to China, in a bid to avoid a repeat of the spending sprees of the previous 2 years, a new kind of tax was introduced in 2018 that stipulated that any club that spent more than approximately €7 million on an overseas player would have to make a payment equal to the size of the transfer fee to the Chinese Football Association. It drastically decreased overseas spending, but harm was done, and almost each year till 2024 at least one Super League club has dissolved. One of most high-profile cases was Guangzhou FC, formerly Evergrande, which was disbanded in early 2025 after its parent company faced massive losses in the real estate market. Okay, so is it really that bad if you're not a billionaire or backed by a sovereign wealth fund capable of sustaining long-term, extravagant spending, like Manchester City, Newcastle, or Paris Saint-Germain? Even without ultra-rich owners, can football still be a viable business, but it's a tightrope walk? Is any example what works? In America, Major League Soccer or MLS has been designed as a highly controlled, sustainable league, taking business-first approach. MLS, unlike European or Chinese clubs, operates under a single entity model, meaning the league technically owns all the clubs and player contracts. Investors buy franchise rights rather than owning the club outright. This reduces the financial risk for individual owners, because losses are absorbed by the league structure. MLS imposes salary caps and rules like the designated player rule, which limits how much any single player can cost outside the cap. Clubs cannot overspend to chase short-term success, preventing the runaway debts common in European leagues. Football is often risky financially, and this why billionaire or wealth fund backing helps, but there are clubs and leagues where football is a good business, mainly due to strong commercial strategies, global fan bases, and sustainable operations, opposite of what we mentioned before. Examples of this include Manchester United, where club is profitable even when not winning major trophies consistently. Financial might of United lies in its brand strength and long-term commercial deals. Another example is Real Madrid, which operates profitably due to high-profile sponsorship deals, stadium tours, merchandise, sponsorships, UEFA prize money, and due to fact that club collects approximately 12% of La Liga TV rights money, which similar number to FC Barcelona's and twice as league average, as TV money in Spain is not distributed evenly. These clubs are so-called superclubs, the very biggest, richest, and most globally influential teams, essentially the sports elite. They operate at a level above even ordinary big clubs. What makes a club a superclub? Massive global fan base. They have millions of supporters worldwide, not just in their home country. Huge financial power. They generate enormous revenue through sponsorship deals, broadcasting rights, merchandising, and global tours. This allows them to buy the best players and pay very high wages. Consistent success. Superclubs usually dominate their domestic leagues and frequently reach the late stages of the UEFA Champions League. Strong brand identity. A superclub is more than just a team, it's a global brand. People around the world buy their shirts, watch their games, and follow them on social media. Influence in football politics. Superclubs often have major influence in governing bodies and competitions, and their interests can shape rules or tournament structures. Examples of current superclubs: Real Madrid, FC Barcelona, Manchester United, Manchester City, Bayern Munich, Paris Saint-Germain, Liverpool, Chelsea. Depending on era, some rise or fall, and even these clubs are not spared from dire financial situations. A strong example is FC Barcelona, which accumulated more than €1 billion in debt and exceeded La Liga's salary cap limits, leading to Lionel Messi's departure in 2021 because the club was unable to register his contract under the league's financial regulations. These clubs usually top the rankings of the world's most profitable football teams, and their brand valuations often exceed €1 billion. The last time a club outside the Super Club group won the UEFA Champions League was in 2010, when Jose Mourinho's Inter Milan completed a historic treble. Since 2008, every one of these mentioned super clubs has won the UEFA Champions League at least once. Another examples of good business cases are transfer selling powerhouses, because their model is designed around sustainability rather than chasing short-term glory, and sometimes sporting results of these goes into background if these possibility to cash in big by selling next superstar appears. Clubs like FC Porto, Benfica, Sporting, Ajax, and RB Salzburg generate consistent profits by selling players for much more than they were acquired or developed for. These clubs rarely overspend on wages or transfers. Most players are young and relatively inexpensive, which keeps the wage bill manageable. Money from player sales is reinvested into academies and scouting networks, creating a cycle of sustainable talent production. Because their business model does not depend on trophy-driven income like TV money or Champions League prize money, these clubs are less vulnerable to relegation or poor results, and clubs like Ajax, Benfica, and Porto maintain strong international reputations while spending far less than elite clubs like Real Madrid, Barcelona or English clubs. But this strategy also is hard to replicate. Take example of Valencia CF, which is an interesting case because, historically, it developed talent but has struggled to consistently act profitable. Here is why. Unlike clubs that buy young players cheaply, Valencia has often chased immediate results, signing more expensive or experienced players. As example, transfers like Dani Parejo, Rodrigo, or Gonçalo Guedes involved significant fees and high wages, which limited profit margins when selling. A hallmark of successful transfer selling clubs is buying low and selling high at the right moment, but under Peter Lim, who is club owner since 2014, sales often seem driven by cash needs rather than a long-term developmental model. Losses under his tenure have been significant. It is big difference how you sell, out of necessity where even buyers know that such necessity exists, or because you got offer too good to decline. As nail in Valencia's coffin is the No Mestalla Stadium, which intended to be a modern symbol of Valencia Football Club's ambition, has instead become a stark reminder of financial instability. Its dormancy for over 15 years reflects both the club's inability to recover fully from the economic shock of the 2008 financial crisis and the broader economic challenges Spain faced during that period. To make a football club a good, sustainable business, several key elements need to come together. It's not just about winning trophies. In fact, as you see, many clubs fail financially despite sporting success and are doing fine without a lot of trophies. A football club becomes a good business when it is governed well, when club balances financial discipline, sustainable growth, smart player management, and brand power, rather than relying solely on trophies or a wealthy owner. The clubs that succeed in the long term treat football as both a sport and a business, building systems that survive even when results fluctuate. Without those elements, football becomes very risky. For clubs without the mega-rich backing, a few bad seasons can lead to serious financial trouble. Very few football clubs are publicly traded. That means that everyone can buy shares of these clubs in stock market. But the vast majority remain private entities or member-owned clubs. Public ownership is relatively rare because football is risky and volatile, and shareholders expect transparency and profits, which not all clubs can reliably deliver. Being a public company can help with transparency and access to funds, but it doesn't automatically make a football club a better business, and let's take a look on some of these companies. Ownership style shapes how clubs generate revenue, manage debt, and plan for long-term stability. Publicly traded clubs prioritize transparency and investor accountability, while private or member-owned clubs can focus more on sporting ambition or tradition, but all models require sound financial management to succeed as a business. Since financial information about these clubs is more readily available, let's take a closer look at the most popular publicly traded football clubs. Examples of publicly owned clubs include Manchester United, Juventus, Borussia Dortmund, Ajax, and Benfica, names that leave no football fan indifferent. Their culture spans the roaring stands of Manchester United, the disciplined elegance of Juventus, the electrifying yellow wall of Borussia Dortmund, the artistic precision of Ajax, and the soaring eagles of Benfica, showing that football is both a spectacle and a business. Each club blends history, ambition, and strategy in its own way. Some chase global brands and commercial power, others cultivate youth talent and profitable transfers, yet all share the same heartbeat of the game, a relentless pursuit of excellence on and off the pitch. Together, they prove that football can ignite passion while being run as a smart, modern enterprise. Let's take a closer look at the business side of each club. But first, a quick note, this is not financial advice, and all trademarks are the property of their respective owners, shown here solely for informative purposes. Manchester United, ticker symbol MANU, is a New York Stock Exchange listed football club with moderate liquidity, averaging around 400,000 shares traded daily. Its share price exhibits lower than market volatility, meaning it is less sensitive to broad market swings, though it can still move based on sporting results or major news. The float is limited, which can occasionally create larger intraday price swings. Financially, the club has been structurally loss-making in recent years. High fixed costs, including player wages and debt servicing, exert continual pressure on cash flows. The company's profit margins are negative, and dividends since 2023 have been suspended. Investors face risks tied to sporting performance, debt, and cost structure. While the brand is globally recognized and commercial revenue is strong, the financial health of the club is fragile, and returns are uncertain. Trading is reasonable, but investors must be prepared for swings linked to match outcomes or tournament participation. Since late 2023, Manchester United's sporting operations are overseen by Ineos. After Sir Jim Ratcliffe acquired a 25% stake, the Glazers retain majority ownership but delegate football decisions to Ineos. A football committee manages coaching, transfers, and academy investments. Early mistakes included high-cost extensions and hires, and due to Ineos' multi-club ownership, UEFA rules blocked at least one potential OGC-NIS to United transfer. The club aims for long-term infrastructure and squad investment, but sporting performance and debt of approximately $650 million remain key risks. Juventus, ticker symbol Juve, trades on the Milan Stock Exchange and has relatively low liquidity compared to major industrial stocks, with trading volumes prone to fluctuation. The stock shows high volatility, reflecting sensitivity to on-field performance, transfers, and market sentiment. Small float size and speculative trading often amplify short-term price swings. The club has historically struggled financially, with recent net losses around €200 million. Its debt-to-equity ratio is high, and liquidity is constrained, leaving it vulnerable to short-term obligations. Profitability is weak, and earnings depend heavily on player transfers and participation in European competitions. Investors are exposed to risks including operational leverage, poor liquidity, and sporting outcomes. While Juventus is a globally recognized brand with potential commercial growth, the stock is high risk, with performance and financial health heavily dependent on management decisions and football results. A mix of financial scandals, the costly aftermath of the Ronaldo era, declining commercial power, and repeated sporting underperformance pushed the club into structural losses. Leadership changes and regulatory scrutiny in recent seasons have created instability in sporting strategy and financial planning. In November 2022, amid mounting financial accounting controversy, the entire board of directors of Juventus resigned, including longtime president Andrea Agnelli and vice president Pavel Nedved. The mass resignation of the board and executive shake-up reflect a crisis of credibility for Juventus, not just on the sporting front but in its corporate governance. Regulatory scrutiny, both sporting UEFA and judicial, has already had real consequences: financial penalties, exclusion from European competition, and serious reputational risk, all of which threaten the club's on-field competitiveness and long-term financial stability. Borussia Dortmund, ticker symbol BVB, a German-listed club with moderate liquidity, trading roughly 129,000 shares daily. Its volatility is close to market average, making the stock somewhat predictable relative to broader equities. Price movements are influenced by sporting performance, sponsorship deals, and player transfer activity, but it benefits from a relatively stable investor base and sound reporting. Borussia Dortmund operates under a German two-tier governance system, supervisory board plus executive board. Transfers and sporting operations are managed by the executive board, with oversight to balance financial risk. Financially, Dortmund has been profitable, with net income around €28 million annually and free cash flow supported by sponsorship and matchday revenues. Debt levels are modest, and the club maintains unused credit lines to manage liquidity risk. Revenue depends significantly on player sales and European competition participation. The stock's risks include fluctuations in cash flow from transfers, dependence on sporting success, and potential sponsor withdrawals. Overall, BVB is structurally more stable than many football stocks, offering moderate returns with moderate risk, though market sentiment can amplify share price swings in key seasons. Dortmund, despite reaching the 2024 Champions League final, has seen long-term share price stagnation because strong seasons have been followed by rebuilding phases that reduce financial momentum. Ajax, ticker symbol Ajax, trades on Euronext Amsterdam and exhibits moderate to high volatility due to dependence on sporting results and player transfer activity. Liquidity is lower than large-cap industrial stocks, and trading volumes can fluctuate significantly around key events such as Champions League progression or major transfers. Financially, Ajax is sensitive to performance-related revenue. Matchday income, broadcasting rights, and player trading are critical to profitability, which can be lumpy. Wages and amortization of player costs are significant, and profitability varies with transfer activity and competitive success. Investors face risks from variable cash flows, transfer market volatility, and dependency on sporting results. While Ajax has a strong brand and regular European competition exposure, earnings and share performance are unpredictable, and returns are closely linked to club management and performance, which goes through some turbulence in recent years, as stock prices steadily decline. The drop in Ajax's stock isn't just about poor performance on the field, it's fundamentally a financial and governance story. Big losses, weak transfer profitability, high costs, and boardroom instability have spooked investors. While there are signs of recovery through sporting and cost discipline, the structural risk remains high. If they fail to consistently generate transfer profits or secure European income, shareholder value could continue to suffer. In the 2024/2025 financial year, Ajax posted a net loss of almost €40 million, largely driven by a very negative transfer results. On the cost side, salaries remain very high relative to revenue, but their revenue lags behind, especially without consistent Champions League income. There has been high turnover in the Ajax boardroom. Key executives and supervisory board members have left or changed roles in recent years, creating uncertainty. Benfica, ticker symbol SLBEN, is listed in Lisbon Stock Exchange. It shows moderate liquidity with trading volume subject to fluctuations, particularly around European competition results or player transfers. Its share price is volatile due to reliance on sporting outcomes and revenue swings from player sales and sponsorship deals. Financially, the club's profits are heavily dependent on player trading. Operational expenses, particularly wages and stadium costs, are high. Cash flow can be uneven, and profitability is closely tied to participation in European competitions, sponsorship agreements, and successful transfer activity. Investors are exposed to sporting risk, liquidity variability, and dependency on high-margin player sales. Benfica benefits from strong brand recognition and regular European competition exposure, but financial and stock performance is highly unpredictable, making it a high-risk investment for traditional equity portfolios. Benfica SAD manages the football business, while the club's socio or membership structure elects the president. Current president is former footballer and one of Portugal's football icons, Rui Costa. Transfers are formally overseen by the SAD board, and the club relies on buying young talent, developing it, and selling for profit. In recent years, Benfica has balanced fiscal discipline with continued investment in infrastructure and scouting. Dual governance requires managing socio expectations while maintaining financial sustainability, making transfer timing and pricing crucial for both sporting and business success. Over the past decade, Benfica has excelled in its role as a talent factory and transfer powerhouse, turning youth potential and savvy signings into major financial value. Their model has generated hundreds of millions in transfer profit and has been crucial to returning the club's finances to positive territory. But there is a risk: if the pipeline of profitable sales dries up, or if they fail to develop or sell top talent, their financial model could be stressed. In last years, their sales include João Felix to Atletico Madrid in 2019 for €127 million, Enzo Fernandez to Chelsea in 2023 for €121 million, Darwin Núñez to Liverpool in 2022 for €85 million, Ruben Dias to Manchester City in 2020 for €70 million, Gonçalo Ramos to PSG in 2023 for €65 million, and Alvaro Carreras to Real Madrid for €50 million in 2025. Since 2021, the strongest stock market performance among mentioned clubs has come from Benfica. However, this outperformance is largely driven by an extraordinary volume of transfer income. Benfica has generated over €1.5 billion in outgoing transfers during this period, leading all European clubs and reinforcing its status as the continent's most successful player trading institution. The club has effectively mastered the transfer market, consistently reinvesting proceeds from the sale of emerging stars into new talent, which in turn sustains both sporting competitiveness and financial momentum. The scale of this strategy is evident when looking at Benfica's top transfers, as listed by Transfermarkt. Interestingly, FC Porto, Benfica's main domestic rival and a club operating a broadly similar player development and transfer-driven business model, has delivered even stronger stock price gains over the past 5 years. I decided to not analyze this club deeper as Porto's has a noticeably lower market capitalization. Porto's success reflects not only substantial transfer profits of its own, but also recent financial restructuring and asset monetization initiatives, as club has sold a minority interest in its stadium commercial rights that have boosted investor confidence and amplified market performance. Manchester United has delivered very modest total returns. Share price saw a big rebound in 2022, but since then it has declined. Several factors have driven this volatile pattern: on-field underperformance, high debt levels, and financial losses weigh on long-term investor confidence. The partial takeover by Jim Ratcliffe raised hopes, but the execution risk of revenue growth and cost control remains real, and some recent sporting setbacks, missing out on Champions League, have hit sentiment. Over the past 5 years, the performances of Borussia Dortmund, Ajax, and Juventus on the stock market have been noticeably weak, with all three clubs generating negative returns for shareholders. A combination of structural and short-term factors has contributed to this decline. The aftermath of the COVID-19 crisis severely reduced matchday income, disrupted transfer markets, and forced clubs to rely more heavily on debt. At the same time, each club has been affected by periods of poor sporting management, inconsistent results, and the erosion of previously strong transfer market advantages. And now let's do some math. If average Joe invested €100 in January of 2015, how much his stocks and divided profit would be valuated today after almost 11 years of investing? As we see, most profitable club again is Benfica due to previously explained reasons. It beats SP 500 index in same period by factor of 2, which is very good result. Here Juventus investors, due to cheap stocks in 2015, have not lost money, while all other club investors have lost it, and Borussia Dortmund have performed even worse than not investing at all. But as you know, historical performance does not guarantee same results in future. The major takeaway is that football club stocks are a very different kind of equity play, not stable blue chips, but businesses deeply exposed to sporting risk, transfer market cycles, and governance issues. They create shared identities, foster social bonds, and serve as spaces for cultural expression and education. More than business, football clubs are entertainment, so enjoy football and be responsible with finances. Thanks for watching. Like, subscribe, and try to guess the football club by its goal song. Hint, this club has a positive goal difference against all the clubs we analyzed based on stock market performance. Leave your guess for the club name in the comments.